Welcome back to The Explainer. Today, we're tearing into a massive transformation happening right now in the tech world. We're looking at Marvell Technology. We're going to unpack their 2026 inflection point, dig into the hidden engine driving their absolute explosion in AI, and, well, look closely at the high-stakes financial trade-off they're making to secure their future. Let's just jump right into the architecture of this AI boom.
130%. That is roughly how much Marvell stock skyrocketed in 2026. I mean, wow. And this wasn't just some market hype either. This surge came right on the heels of a massive first quarter for their fiscal 2027. They reported a record $2.418 billion in net revenue, completely blowing past expectations thanks to surging AI data center demand. But you know, that headline beat? It actually hides a much more interesting story about what Marvell has actually become.
Okay, let's dive into this because the real transformation is right here in their revenue breakdown. Marvell is no longer just some diversified infrastructure chip maker that happens to sell into data centers. Look at that massive 76% slice. That represents $1.83 billion of revenue coming strictly from data centers. So for all intents and purposes, Marvell is now an AI infrastructure pure play. Their products are literally the connective tissue holding these massive AI clusters together.
So now that we know what they do, we need to understand exactly how they protect it. Section 1. The moat. A two-horse race.
When it comes to merchant custom AI silicon, it's pretty much Marvell and Broadcom on one side and, well, everyone else on the other. It's a strict ASIC design duopoly. And ASIC just means they build application-specific integrated circuits, chips perfectly tailored for one exact task. Designing a leading-edge accelerator, yeah, that's not something a startup can just decide to do in a garage overnight. It takes deep expertise in advanced process nodes, high-speed interfaces, advanced packaging, and IP libraries that literally take billions of dollars in years to build. So new entrants simply cannot just appear out of nowhere to challenge them. These two are completely locked in a two-horse race for computing's most strategically important sockets. Right, so what's the actual engine driving Marvell's side of this duopoly? Let's get into Section 2. The secret weapon, custom XPU silicon.
The absolutely crucial point here is the number 18. Marvell's defining strength is their custom XPU silicon business, basically building specialized processing units for specific clients. And get this business exploded from near zero to a roughly $1.5 billion annual run rate in a single fiscal year. How? By securing 18 specific, multi-year design wins across the absolute titans of the industry. We're talking Amazon, Google, and Microsoft. And once these hyperscalers commit to Marvell's silicon for a whole generation of accelerators, the switching costs are enormous. Marvell is totally locked in.
And this is where the magic really happens. We call this the Attach Multiplier, because the design win isn't just a one-and-done sale, it steps up into this incredible compounding annuity. Step 1 is winning that custom XPU silicon socket. But think about it. Every new processor added to a cluster has to connect to all the others, right? That leads to Step 2, the interconnects around that socket. And that's a business Marvell guides to grow more than 70% year over year. Wild. Finally, Step 3, it pulls in optical DSPs. Those are the chips that translate digital data into light signals for way faster transfer, along with switching. So your revenue per design win multiplies rapidly as these AI clusters scale up from thousands to literally hundreds of thousands of accelerators.
Now, as incredible as that compounding growth is, every great empire has a cost. That brings us to Section 3, the plot twist, the gross margin trade-off.
This right here is the fundamental structural shift happening inside the company. It's the margin trade-off. See, custom silicon is the fastest growing part of Marvell's business, but it actually carries lower gross margins than their traditional off-the-shelf products. As custom silicon scales up to become the dominant chunk of their revenue, their blended margins face some serious ongoing pressure. They are intentionally taking a hit on margin percentages to grab massive volume and secure that long-term customer lock-in.
And this brilliantly illustrates the tension playing out right now. Gross margins actually slipped from 59.8% in Q1 of fiscal 26 down to 58.9% in Q1 of fiscal 27. And look, this isn't just some cyclical blip, it's the structural reality of their new business model. To win those massive, multi-year hyperscaler contracts, they simply have to accept a slightly smaller slice of the pie. They're banking heavily on the fact that the pie itself is growing exponentially.
But margin pressure definitely isn't the only risk to the strategy. Let's look at Section 4. Vulnerabilities in the empire. The risks here are heavily concentrated. First up, hyperscaler insourcing. The very same customers that make up Marvell's biggest wins, Google, Amazon, Microsoft, are also busy designing their own chips. Think Google TPU, Amazon Trainium, Microsoft Maya. It's a symbiotic partnership until someone makes a strategic decision to bring more design in-house, right? Second, Marvell is completely fabless. They depend almost entirely on TSMC for manufacturing, and a capacity bottleneck or geopolitical disruption in Taiwan could instantly freeze their ability to deliver. And third, they are fighting absolute giants. They have to out-execute Broadcom on custom wins while simultaneously defending their interconnect share from an incredibly aggressive NVIDIA.
And then there's this massive gap exposing an underlying vulnerability in their profitability. Marvell reported adjusted non-GAAP earnings per share of 80 cents, which honestly looks fantastic, but look at their GAAP earnings. You know, the standard strict accounting measure. It sits at just 4 cents per share. 4 cents. This massive discrepancy is caused by incredibly heavy stock-based compensation and the lingering amortization of intangibles from massive past acquisitions like Infi and Cavium. It's a stark reminder of the very expensive path they took to build this AI portfolio in the first place.
But despite those vulnerabilities, management is heavily pressing their advantage. Section 5. The Ultimate AI Bet. Looking to 2028. Management has aggressively hiked their guidance, targeting $11 billion for fiscal 2027 and a staggering $15 billion for fiscal 2028. It really all comes down to two opposing forces. The bull case is that unstoppable compounding growth of the attach multiplier, every custom win becoming a long-term annuity of interconnects and optics. But on the flip side, the bear case is that same growth driving margin compression, all while the stock's massive 130% run assumes literally flawless execution. I mean, one missed design win or a sudden hyperscaler spending pause, and a stock price for perfection like this has absolutely zero room for error.
Which brings us to the final, defining question of this explainer. Will the massive volume and deep customer lock-in of custom silicon ultimately out-earn the margin compression it creates? Marvell has successfully positioned itself as a highly privileged partner in the global AI build-out, basically transforming its entire identity to capture this exact moment. But, as always, execution is everything. Keep this question in mind as you watch Marvell navigate the next 2 fiscal years. Thanks so much for joining me, and keep exploring.